All right, so let's continue. Now, if we think about what we talked about at the very beginning of this presentation, we listed wages and salaries, and we also listed taxes as a type of current liability, and that's absolutely the truth. Now, I want you to bear with me as much as you possibly can and put on your thinking caps if you have one available, because payroll taxes for beginning students, even accounting students, is a bit problematic. It's not a piece of cake in any way, shape, or form. This particular presentation is not designed for accounting majors. Therefore, I expect you to have, at least I expect some of you to have some difficulty with this. But if you will stick with it, I think it will all become completely clear unless it's unclear. Okay, so let's think about payroll and payroll taxes as they pertain to a company's liabilities. Almost all of you watching this who've ever sat in the classroom have had a job, or you know someone who has had a job, okay? And especially for those of you who have had a job, you will be aware of the fact that if you, let's say that you get paid every week, okay, and you work Saturday through Friday, that first Friday comes when you're on the job, guess what happens? Well, for you, nothing. You didn't get paid. But you will get paid the next week. However, on that week 2, you're actually getting paid for week 1. So what? Why does that matter? It matters because as soon as you have worked that first week, your employer has an obligation to you in the form of a liability, okay? Again, I can't emphasize enough, accrual basis of accounting stipulates that we recognize liabilities when they are incurred, okay? So payroll is, for most companies, the biggest current liability, or at least one of the biggest current liability, usually the biggest. We have some terms here. When we talk about payroll, we can be talking about salaries. These are salaries are just people, individuals who get a certain set amount per month, per year, whatever the case may be, $60,000 a year, $80,000 per year, that sort of thing. It doesn't matter how much they actually work. Oftentimes they work quite a bit. Wages, on the other hand, these are usually calculated on a per hour basis. However, as they pertain to payroll, it really doesn't matter what we're talking about because they represent liabilities on the part of the company until they are actually paid. Okay? So, it says here that determining payroll involves computing 3 amounts. That's absolutely the truth. Gross earnings, okay, payroll deductions, and net pay. Okay, well now that's true. That will help us determine to determine payroll, but that doesn't tell the full story. That does not give us an indication of what our total payables are, what our total liabilities / obligations are. But that's a good first step, okay? So we have here an example, and looks like, I know you guys probably don't like the way this is lined out, but it looks like, and I'm gonna kind of help you out here a little bit. It looks like we had gross pay, whether these are salaries, wages, is irrelevant, of $100,000, okay? $100,000. And so we have a lot going on here, but sadly this is not all that's going on. Looks like the employees earned $100,000. They had state income tax withholdings of $29,22, federal income tax liabilities $21,864, and FICA, that's your Social Security and Medicare taxes, totaling $7,650. Okay, so if we say the employees, we've withheld this from their pay, we've withheld federal income tax, and we've withheld their Social Security and Medicare out of their pay, the employee's net pay is going to end up being this $67,564. This is what all the total of all the paychecks to employees are going to total. Well, we immediately have a problem in that we paid out $67,564, but our expense is $100,000. Well, where's the rest of it? Well, what we did was we increased liabilities. Okay, we have increased liabilities. As an employer at this point, we owe the state tax commission $29,22. We owe the U.S. Department of Treasury $21,864, and we owe the Social Security Administration via the U.S. Treasury another $76.50. So in this, we had a total obligation of $100,000 as soon as the work was performed, but when we break it down, we actually had 4 different obligations, one to the employees and one each to these 3 regulatory agencies here. Okay, we've now paid the payroll, so this $67,564 obligation, which was initially set up right here, it goes away, but we still have these 3 outstanding. Okay, we also need to discuss something that is very important, particularly if you ever have designs on owning your own business, and that is that in addition to the obligations, the liabilities that we set up, those 4, right? We had an obligation to the employees, to the federal government for income tax withholding, to the state government for income tax withholding, and to the Social Security Administration, Medicare. We also have some additional obligations as employers that we're going to have to consider. These are liabilities. Employers are required to match the FICA tax out of their own pocket. So let's go back to the previous slide for just a moment. This $76.50 here, this came directly out of the employee's check, okay? This came out of the employee's check. The employer, must also match that same $76.50, okay? Additionally, employers are obligated to pay federal unemployment tax and state unemployment tax. These are sometimes referred to as FUTA and SUTA, okay? FUTA-SUTA, okay? These 3 obligations are not withheld from the employee's pay. These are separate taxes that the employer pays as a business expense. And until they pay them, they have an obligation or a liability, a current liability, because these are due at the absolute most every 3 months. For some employers, these are due much more frequently. In fact, after every payroll for most large companies. So here we have the previous example. We set up we had the $100,000 expense, and we showed the 4 liabilities that we had from that. These liabilities are wholly separate. It says based on this company's $100,000 payroll, the company would record employer's expense and liabilities for payroll taxes as follows. The FICA tax is matched dollar for dollar, penny for penny, what the employee has to pay. Looks like in this particular situation, we had federal unemployment tax of $800 and state unemployment tax of $5,400. These 3 obligations, in order to keep the accounting equation intact, must reduce retained earnings. Okay, these are eventually going to be, these are going to be recognized as a payroll tax expense. And those will absolutely positively show up on the income statement as a reduction to net income. All right, a little review question here. It says, read it carefully. Employer payroll taxes do not include, and then we have 4 choices. Well, if you've been paying attention, the answer should be crystal clear. And if you happen to have access to this PowerPoint independent of the video, you've already slipped to the next slide and gotten the answer if you didn't know it. So let's take a look at the answer. The answer is federal income taxes. Federal income taxes are withheld from the employee's check, from the employee's gross pay. It's one of the items that's taken out in arriving at net pay. Federal unemployment, state unemployment taxes, and the employer's portion of FICA taxes all have to do with the employer. So they tried to throw you off right here a little bit, but if you were paying attention at all, you probably were able to figure out that the answer was in fact C. Okay? All right. Moving along. This slide has some detail that's going to be very, very difficult for you to read. So if you do not have access to this PowerPoint and you're just strictly watching the video, you can kind of put an X through this because you probably can't read it. I know I sure couldn't. But we can still look at the example. It says during the month of September, Lake Corporation's employees earned wages of $60,000. That's called gross pay. Withholdings related to these wages were $3,500 for Social Security. That would actually be Social Security and Medicare, I believe. Let's move along. $6,500 for federal income tax and $2,000 for state income tax. It says the employer incurred costs for unemployment taxes of $90 for federal unemployment tax and $150 for state tax. Prepare a tabular summary, blah, 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 blah. Okay, so I have a sneaking suspicion that you don't want to perform a tabular summary, so we're going to go through these and we're going to understand what has to happen for each of these items. Okay, so our payroll expense is $60,000. An expense is not a liability. Okay, but our initial liability was $60,000 in total, not accounting for the employer only portion of the tax. All right. So $60,000. Withholdings related to these wages were $3,500 for Social Security. Well, what we need to understand is that this $3,500 here, the employee's portion of this $3,500 is already inside this 60,000. Okay? But the employer's 3,500 is not in this 60,000. So we just increased our payroll liability by $3,500. Okay? Next item, $6,500 for federal income tax. Again, this is different. The $6,500 is wholly included in this this $60,000 here. So we have not increased liabilities. We've just said, okay, this is $6,500 that the employee is not going to get, and this is $6,500 that the federal government is going to get. So we have an obligation to the federal government for this $6,500 here, but that does not actually increase our overall obligation in terms of dollars at all. Same thing is to be said for this $2,000. This $2,000 is a part of this $60,000 obligation. Okay. However, moving down, it says costs incurred for unemployment taxes, $90 for federal and $150 for state. Both of these are strictly on the employer. So our total obligation has gone up by $240. $90 for the federal unemployment tax and $150 for the state tax. If you can halfway read this, you will see that everything I just told you is the truth. Okay? It's all true. All right? That $60,000 was originally, if we were to break that $60,000 liability down, we would see that it was made up of $48,000 in net pay to the employees, $2,000 in state withholding, $6,500 in federal income tax withholding, and $3,500 employee portion of the FICA, the Social Security and Medicare tax. Okay? We're going to add to that, as I've already told you, $3,500 right here under B for the employer's portion of FICA tax, and then also $90 for federal unemployment and $150. If we come over here to the right side, we see that we have two different expense obligations. $60,000 is our salaries and wage expense, or our payroll expense. $3,740 is our payroll tax expense. That's the $3,500 over here in the first column, plus the $90 right here, federal unemployment tax, and the $150 state tax. So our total obligation initially were these two figures combined, $63,740. Okay, I want to talk about bonds very, very quickly. This is a survey of accounting class, so we are not going to get into bonds nearly as deeply as your textbook seems to want us to get into bonds. That is because your textbook can be used either as an introductory course book or in MBA classes. So, with that said, what I want you to understand about bonds is simply this. Bonds are a way that a company raises funds. They generally sell bonds in increments of $1,000 a piece. So you buy a bond from a company for $1,000. You give them the $1,000. You become a creditor to that company. They owe you the $1,000, and they owe you interest on the $1,000. Now, bonds are generally considered a long-term obligation or a non-current liability because typically they last about 10 years is kind of a general rule of thumb. So these are non-current liabilities, but bonds payable is most definitely a liability for the company. Okay? So when you own a bond, you are a creditor of the company. You may own a bond that was issued by the company, but you do not own any part of that company. Much the same way as if you were to borrow money from the bank, you would owe the bank money, but let's say that you borrowed money from a bank to start a business. Well, the bank does not own the business. They would just have a claim against your business for the amount of the loan. Okay? So let's get into a little bit of terminology before we move on. It says here, face value is the amount due at maturity. So if you have a $1,000 bond at maturity, you are owed your $1,000 back. It would be very, very similar to the principal amount of a loan. The maturity date refers simply to when the face value of the bond is paid. And the stated interest rate or the contractual interest rate is going to usually be stated on the bond, and that's going to determine the amount of interest that is paid. So for example, if you have a $1,000 bond that pays 6% interest, you would be owed $60 per year. And let's say that was a 10-year bond, you would get $60 10 times, assuming it was that interest was paid once a year, you would get interest of $60 10 times, and then at the end, you'd get your $1,000 back. So over the 10-year period, you would end up getting back a pretty good return on your investment, about $1,600. And in fact, it would be exactly $1,600. Okay? But we want to understand that these are long-term obligations, long-term liabilities. An investor, in this particular sense, is a creditor, not an owner of the company. All right, we have some stockholder rights that we need to talk about because we need to understand conceptually the difference between bondholders and stockholders without getting into too much detail. Okay, so we're talking about stockholder rights, and it says shares and assets upon liquidation in proportion to their holdings. So if you own 10% of a company and that company liquidates after they've paid off all of their debt, you would be entitled to the remaining 10% of assets. Residual claim means simply what is left over. So if we think about this, bondholders are right here. Bondholders have superior claims to company assets in the event of a liquidation, and stockholders are over here at the end. And that makes sense because we don't want to have a situation where our owners are getting paid in the event of a liquidation before we actually go out and pay all of our bills. Okay, that wouldn't be fair. Okay, so it says here that when we talk about issuing stock, and anytime you start a business and you put money into that business, you have stock in that company. Okay, you may not think of it that way, but you do. Okay, so if you invest $25,000 to start a company called Net Solutions Incorporated gets the $25,000, you get $25,000 of common stock. Okay, we're not going to get into this point here. All right? Especially because direct issue is typically what we're going to talk about in closely held companies, small businesses, that sort of thing. Okay? So, stockholders are, in fact, owners of the company. Bondholders, they increase liabilities. Stockholders increase common stock. Two different parts of the balance sheet. All right, a little bit more detail here. When we talk about corporate capital, this is getting into a lot of detail here, but what we want to understand is that we have two primary parts of stockholders' equity. We have our retained earnings that come from our income on the income statement, but we also have paid-in capital. These are our owner investments. Paid-in capital represents owner investments into the company, okay? And then what we have done here is we have further complicated things by saying, okay, we're also going to show you that some owner investment is classified as what's called common stock, and some owner investment is referred to as preferred stock, okay? And if that's not good enough for you and this is just too easy, don't worry, we're going to make it harder by saying, well, we're going to break this down further into this concept of paid-in capital in excess of par over here on the right side of the screen. Okay? Fun, 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 fun. Okay, we've kind of already talked about retained earnings, but I'll just reiterate, is net income that a corporation retains for future use in the business. Okay, and we'll get into what that means when we talk about retains, probably in the next presentation. Let's see what we have here. So we had on the prior slide, we had those two squares where we had common stock and preferred stock, and then we broke it down into this thing. We also introduced this concept of paid-in capital in excess of par. So it says here, when we account for common stock, identify the specific sources of paid-in capital, okay? But then we also want to maintain a distinction between paid-in capital and retained earnings, okay? And we've really already talked about that. Paid-in capital, owner investments, retained earnings. This is our net income that has been retained inside the company, okay? Let's move on. So we have an example here. Hydroslide Incorporation has issued 1,000 shares of $1 par value common stock. This transaction is recorded as follows. So let me just say one thing really quickly, and that is that this presentation here is what you have been used to. This is how your textbook, regardless of what textbook we're using, is going to introduce the idea of owner's equity in the very, very beginning. Assets go up by $1,000. Common stock goes up by $1,000. We do not, in this particular example, address this concept of paid-in capital in excess of par. So let's just say that we were starting a business called Net Solutions, and we had a fellow named Chris who wanted to invest $25,000 into Net Solutions, and he did that. Cash would go up in that scenario by $25,000, and common stock would go up by $25,000. Ring a bell? Okay. But now we're going to complicate things a little bit more. This is an additional transaction. It says, now assume that Hydroslide Incorporated issues an additional 1,000 shares of $1 par value common stock for $5 per share. The amount received above the par value, in this case, $4, they used a process called subtraction to figure that out, would be added to paid-in capital in excess of par, and it is recorded as follows. So They've sold stock for $5,000, so cash is going to go up by $5,000. Hopefully that makes sense. Okay? Common stock goes up by $1,000 because they had 1,000 shares at $1 par value per share. But we have to account for that other $4,000 that we got, otherwise our accounting equation is going to be a mess. So what we're going to do here is we're going to increase paid-in capital in excess of par by $4,000. Assets go up by $5,000. No liabilities to account for. Equity goes up by $5,000, but in two parts. $1,000 common stock, $4,000 paid-in capital excess of par. Okay. At this point, I believe you have all of the information that you need to answer the first side of your second handout for the week. Okay, and if you don't know which side is the first side and which side is the second side, I believe I did number those, and if I did not, I apologize. But you can just look at the side that you have an inkling of what the answers are and know that that is probably side number 1.